So, you're retiring in New Jersey, and you've probably heard about the awesome tax break for retirees, right? A pension exclusion of up to $100,000 for married couples. It sounds great, but there's a brutal trap hiding in the tax code that can cost you thousands. Today, we're doing a deep dive into this tax cliff to make absolutely sure you don't fall off. Okay, let's get right into it with what I call the $1 disaster. Picture two identical retired couples. One has a New Jersey gross income of exactly $150,000. The other? They make just one single dollar more. Seems like no big deal, right? I mean, it's a buck. But in New Jersey's tax world, that $1 can cause a financial earthquake. Get this. That one extra dollar can trigger an extra tax bill of over $2,000. Yeah, do the math on that. That's an effective tax rate on that single dollar of over 200,000%. No, that is not a typo. It's the insane reality of a tax cliff. So here's our game plan. We're going to break down the anatomy of this cliff, show you how to shield your income, expose a really nasty trap specifically for teachers, and then, of course, give you some real solutions. And hey, stick around, because we'll even see if this whole mess might be going away soon. All right, first things first. To keep your retirement savings safe, you have got to understand how this danger zone is built. So let's dig into the mechanics of how this tax break is really structured. And here's the absolute key. You know how the federal government kind of eases you out of tax breaks, nice and gradual? Well, New Jersey doesn't do that. Nope. It uses a series of hard lines in the sand, these income checkpoints. You're either on the safe side or you've gone right off the edge. There is no soft landing. And look, don't just take my word for it. This isn't some secret I found. It's right there, plain as day, in the official rulebook from the New Jersey Division of Taxation. This table lays out the hard numbers. And as you'll see, when your income goes up, your tax break doesn't just shrink, it nosedives. This shows you the steps down the cliff perfectly. Think of it like a series of danger zones. For a married couple, if your total income is under $100,000, you're golden. That's the safety zone, full 100% exclusion. But the second you make $1 more, bam, you hit the first drop, and your exclusion is cut right in half. Cross the 125K line, you're on the precipice, and it drops again to just 25%. And that final dollar that pushes you over 150K, poof, it's all gone. The entire benefit just vanishes into thin. Now, this is probably the biggest mistake people make, and it's how so many retirees get tripped up. So please pay close attention here, because this is the single most important key to staying safe. It all comes down to what New Jersey actually counts as income. Forget about your federal taxes for a minute. That number you see on your federal return, your AGI, it means nothing here. Seriously, New Jersey does not care about it. The one and only number you need to watch like a hawk is your New Jersey gross income. And trust me, they are not the same thing. But here's the really good news, and it's a huge piece of good news. You have a secret weapon. New Jersey is one of the few states that does not tax your Social Security benefits at all. This is your most powerful shield against the cliff. Let me be perfectly clear. Your Social Security income is completely invisible to New Jersey for this calculation. It does not count towards those cliff thresholds. So think about it. A couple could get $50,000 in Social Security and $95,000 from a pension. To the feds, that's a lot of income. But in New Jersey's eyes, their income is only $95,000. They are safely under the cliff. Okay, I need all the retired New Jersey teachers and public employees to listen up. This next part is specifically for you. If you have a 403(b) retirement plan, you could be walking straight into a double taxation trap that inflates your income and pushes you right over the cliff. So here's the deal. It's a weird quirk of history. With a 401k, your contributions were pre-tax for both the feds and the state. Simple. But with a 403(b), only the federal government gave you that pre-tax break. New Jersey actually taxed you on that money way back when you earned it. And that's the key point. You have already paid New Jersey income tax on the principal in that account. And there's a name for this pool of already taxed money. It's called your NJ basis. Think of it as your money that the state has already taken a bite of. So when you take it out in retirement, you shouldn't have to pay tax on it a second time, right? Well, the trap is that's exactly what happens if you just copy the big number from your federal 1099-R form onto your state tax return. If you do that, you are literally volunteering to be double taxed, and you're making your income look bigger than it really is. The fix? You have to use the worksheets in the New Jersey tax instructions, either the 3-year rule or the general rule, to properly subtract out your NJ basis. That lowers your reported income and helps keep you under the cliff. All right, we've identified the dangers. Now for the good stuff, strategy. Because avoiding this cliff isn't about crossing your fingers and hoping for the best. It's about being proactive and actively managing your New Jersey gross income, especially as you get toward the end of the year and you're getting close to one of those edges. So here's a pro tip, a tool that's super powerful, but most people don't even know exists. Worksheet D. Let's say you're a couple with that $100,000 exclusion limit, but your pension is only $70,000. That leaves $30,000 of your tax break unclaimed. Well, this worksheet lets you apply that leftover $30,000 shield against your other retirement income, like IRA withdrawals or interest. It's an awesome way to maximize every dollar of the benefit. Now, of course, there are rules. You've got to be 62 or older and under the big $150K cliff. But here's the real kicker. Your earned income, meaning wages from a part-time job or a small business, has to be $3,000 or less. But beyond specific forms, the big picture strategy is just income control. If you're near a cliff in November, maybe you just wait to take that IRA withdrawal until January. The key is to monitor your NJ gross income and be ready to make moves before December 31st. So, after all this, you're probably wondering, this is crazy. Are the politicians in Trenton doing anything about it? It's a fair question. Is there any light at the end of the tunnel? Let's take a look. And the answer is yes, kind of. There is a bill in the works, Assembly Bill A3925, and its whole purpose is to fix this exact problem, to expand eligibility and increase the exclusion amounts, basically softening or removing the cliff for folks making over 150 grand. But, and this is a big but, here's the reality check. That bill was introduced way back in March of 2024, and as of today, it's just pending. So while there is hope for the future, you absolutely must plan your finances based on the rules that are in effect right now. Hope is not a tax strategy. And that really brings us to the final critical question. While lawmakers debate the future, your retirement is happening now. The cliffs are real, the penalties are severe, and the only person who can truly protect your savings is you. So I'll leave you with this. Are you actively managing your income to make sure you stay on the right side of that $1 line?